Hey, welcome back to The Bottom Line, a road trip. We're in Waterloo, the technology triangle, miles and miles, or kilometers and kilometers away from Bay Street and those big banks and brokerages. Things are happening here. We need some angel money, so we brought some to the show. We're joined now by Rob Douglas from R.L. Douglas, that would be you, and Associates. Hi, Rob. Stewart Campbell is from Caldwell Capital. Hi. And the one and only Lou Skeezes.
Mike, what a pleasure to be here in Waterloo with you, huh?
Isn't this good? The place got a buzz about it, hasn't it?
The excitement, you know, in the green room with all the technology experts and venture capitalists all come together, you know.
Yeah, well, you have about $10 billion of market cap in there with you, Lou, which I know gets your heart beating.
Well, you know what I like about the rich, Mike, is how they treat me when I hang around with them. You know, that's my favorite part.
You could be a politician with attitudes like that. Okay, venture. Even before the venture comes the angels. Tell me what stage you start sizing up an entrepreneur as a potential investment.
I start working with companies who have probably been around a year or two, have invested
late stage stuff.
Oh, late stage, absolutely. They've probably invested their own hard-earned dollars to get a business started, have borrowed some money perhaps from family and friends, and a little bank debt might be in there, and very often they've...
Keeps their feet to the fire.
It does, but by the same token, they perhaps have exhausted some of those resources and are still not at a plateau where they would be considered investment ready or attractive for formal venture capitalists. So I move in at that stage where a little bit of money combined with a little bit of assistance in areas like strategic planning and corporate governance and financial management may get a company over the hump and make them more attractive for my friend Stewart.
Okay, so my question is, you have to be over-solicited with offers to consider financing different ventures. Rob, how do you screen out the winners from the losers in the early stage?
It's difficult to screen them out, but I always go back to the point that management and clear understanding of one's market are two key indicators that I have to look for. So I often meet early stage companies that are in a either low revenue stage or sometimes even pre-revenue, where it would appear that they don't have a good handle on where they're going. So from my standpoint, I can't assist those people as I would want to. So I like to meet with people who have a very clear vision, have a clear plan, and have an ability or an apparent ability to execute that plan given some additional resources.
So management and market potential, those are the two things that if you don't have them, they can't come into your game.
Absolutely.
You know, Stuart, some VCs have told me if they actually have a written business plan, it's too late. You know, we want it when it's on the back of the envelope. And these people, of course, fancy themselves as somewhat of gunslingers, and you know, and they say they can pull the trigger on a phone call. It sounds like you're a little more cautious than that.
We have quite a range that come through our doors. We've got folks that have worked with the likes of Rob in the angel community. We've got folks that are 2 and 3 years into their business, are in the revenue stage, are enjoying high growth. And that's typically when they need to have the additional capital. In the high technology areas, as we're sitting in the middle of in Kitchener-Waterloo, we've got a lot of different stages, actually. We've got companies that are on a high growth stream 6 months into their business. They're in the internet space. Things are going extremely rapidly. An internet year is equated to about 3 months. And a number of these companies have to get to significant size or be gone tomorrow. So we have that type of company, which is a very different type of company to finance than a more traditional type of company. Traditional, they come with their business plan, they've got good revenues built up, they've got growth that's based on solid foundation, and they're growing the business as we've often known it. So we have, in this area, high-end manufacturing, we've got the technology sector.
Stu, how do you evaluate the technology? Obviously, there are very bright scientists and technologists that come to you with atoms, electrons moving down a pathway. How do you assess whether or not it has viability in the marketplace from a capital point of view? Because technology, you have to have an assessment in order to judge its market potential.
I think there's a number of things that go into that puzzle. One is being surrounded by talent, as we are in Kitchener-Waterloo. It is a strong technology area. There are people that we can call on at a moment's notice to give us an assessment of whether the technology is good. And being in the marketplace, you get a feel for what is happening in that marketplace and what's good and what's bad. We go through stages. Certain things are good today that are not good tomorrow, and that will evolve over time. The availability of capital to us dictates what we look for as well.
You know, so many people want to play this game now, you know, because there have been such successes. People are trying to bag an elephant, and they got to think, oh, we got to be there first. We got to be in real early. We had someone on the program last night. They're actually having a contest, you know, for kids to submit business plans, and the winner gets an investment of $250,000. Too many people trying to be VCs these days?
There are lots of people potentially who could be VCs, and I think that there are lots more people out in the marketplace wanting to be financed than there are VCs available. That's not to say that there is not capital behind the VCs that would help a lot of people, but the tools to connect the sources of money with those who need it are not formally established in many cases, not at the angel investor level in particular.
Yeah, you don't advertise in the yellow pages under angel investor, right? So how does somebody find you, Rob?
I walk around with a halo usually.
Little wing.
I got one on the
My
car.
first clue. Okay.
Okay. It's primarily a matter of networking.
Okay.
We have a wonderful high-tech association here called Communitech. They have a division called CTAN, which works particularly with early-stage growth companies to make them investment ready. There are certain situations that they may run into that are not appropriate, not a good fit, and I get referrals from that source, as well as through people like Stewart and others.
Stewart, a question I have for you in talking with some of the technology leaders that I know across Canada, they always say that Canadian venture capitalists ask too much of the company. They're looking for 60% of the company, early stage financing. How do you address that when, you know, they say to me knowledgeably, I can go to the Valley and give 20 points to get what I'm looking for. Is it a matter of Canadian VCs have got to get their adjusted cost in line as well?
I think there's a certain amount of that. I think by the nationality we tend to be more conservative in nature, and that runs right through the banking stream as well.
Okay.
A lot of the venture capital that's actually available today is coming out of the bank sector.
All right.
So it is a typically very conservative sector. We are seeing, as we evolve in the technology side, we're seeing much more cross-border dollars changing hands. Typically, the US VCs would like the early stage money to be done locally, and then they would like to jump in and bring the very serious dollars to the table, along with the public markets that are available in the US.
So the follow-up is that the reason that the control block is considered appropriate as a nationalist thing, that the money's coming out of the Canadian banks, so of course they're going to have control just like a mortgage. Is that the rationale?
I think they're loosening the purse strings significantly in the last couple of years.
Yeah, because a number of deals, I mean, the way I'm hearing it on the street is that a lot of deals are getting cut out. Canadian companies are getting cut out because they're going directly down to the Valley or down to New York, and now they've got to start to buck up and get reasonable, or else they lose the opportunity and they can't continue to see that stream of deals leave this country.
Exactly. We too want to keep the talent in this area. We want to build this area. This is a wonderful, vibrant area with new businesses. We want to continue to build the dollars in this area so it services the companies in this area.
Now with Caldwell Capital, right now you facilitate the financing. You put the two ends of the deal together. Do you see a point where you're going to be bringing your own capital pool together and being an owner as well as a broker?
Absolutely. That is an area that we are working aggressively on, is to facilitate the early stage financing, where Rob would be bringing angel capital to the table. There's another level that we typically call the black hole, which would be in the $300,000 to $500,000 range, which gets that company up to being venture capital ready. And that's what we are currently facilitating as well.
Well, we've got a couple of companies that may be venture capital ready. They're companies I don't know. Maybe you do. Probably you do. They're emerging companies. They're here in Waterloo, and we're going to meet them next. But first, thanks to Rob Douglas and Stewart Campbell for the insights on angel financing. Here come a couple of the emerging companies after the break.